What a time for us to be having this conversation.
It's a wonderful time to be representing gold.
I was about to say, you must be busy.
Oh, you're not kidding. That's why I'm here instead of being home in New York.
So what's going on?
I think three things really have been the major drivers so far. The first is very strong central bank buying, mostly from emerging market central banks, which have realized over the years that they are overweight dollar-denominated debt in their official reserves and underweight gold, which is one of the most popular things for their populations, with less than 5% of their reserves in gold. So for 14 straight years now, emerging market central banks have been net buyers of gold for their reserves. That's not going to go away anytime soon because they are still underweight in gold. The second thing we've seen over the whole of this year, a big revival in Chinese investment. And I think that's because the Chinese investor is conscious of all the problems in the real estate sector and is running scared of his local stock market. So the Chinese investor in droves has turned back to the traditional alternative, which for thousands of years has been gold. And then we've also seen, for different reasons, a big revival in Western world investment as well, in North America and Western Europe, because they're worried macroeconomically. They're delighted that the Fed has decided to cut rates, and therefore the dollar is going to soften. Gold tends to go up when the dollar softens. They're also very worried on the geopolitical front. So all of those things together, I think, have driven gold prices to this great succession of all-time highs we've seen.
So the dollar has been strengthening, though, and gold still rallies to record highs. Real rates are also higher. I mean, do I just ignore all that? That doesn't matter?
All sorts of weird things have been happening. You've seen the S&P 500 set a succession of all-time highs, which is a risk-on asset. You've seen Bitcoin setting a succession of all-time highs, the ultra risk-on asset, and gold, the absolute ultra risk-off asset. And that's a weird kind of situation. I think investors in gold have been turning to gold because they see this tremendous appetite for risk across the markets, whether it's equity buyers or crypto buyers. And the thought is, well, if everybody is so gung-ho about risk, maybe I should perhaps up my exposure to the risk-off asset, because eventually they will turn to that. And I think that's really why we've seen all three of those things go up so dramatically.
I mean, you've covered gold for many years. Is gold a risk-on asset, or is it a risk-off asset?
Gold is the ultimate risk-off asset. Gold basically offers you protection against a whole succession of risk. It doesn't have any strong relationship to anything else you'd find in a typical portfolio, so it's spreading your risk. It also is a good protector against sustained high inflation. It's a good protector against potential weakness in the equity markets. That's been demonstrated time and time again. And it also offers you some protection against potential weakness in currency, whether your currency is the Hong Kong dollar or the Chinese renminbi or the US dollar.
With this recent revival in prices, do you see a lot of the physical market and the supply there coming, a lot more coming online because of what's taking place? How does this affect how companies think, gold mining companies think about their plans?
Typically when we see very, very high prices, especially high prices at a sustained level, which we've seen now for a year or so, the gold mining companies tend to cut back on their supply, because what they try to do is to mine to the average grade of ore in their mine, and the more the price goes up, then the more ore can be turned into gold. It becomes that way. So that supply often goes down. Mine production often goes down as the price goes up. Now, we haven't really seen that yet. Gold mine production has continued to go. But that's mainly because gold mining companies are very, very inflexible. They set out a mine plan which might look to 30 or 40 or 50 years ahead, and they more or less have to stick to that. They don't have the flexibility to change course.
I think we want some numbers now and targets. We've already gained, a third this year in terms of gold prices. How much more upside are we talking about now?
I am not as optimistic as certain people on Wall Street are. I mean, a lot of people on Wall Street have been talking $3,000 gold before the end of the year. I'm not going to predict that. I think we will probably see the $3,000 target at some point, but my guess at this point is it probably won't be until next year. But I think that we can see further upside from here. Close to 2,800, it's difficult to see how much we'll see, given that we've already had such great gains.